In my last video, I showed you how Amazon gets to collect cash from customers before they even have to pay their vendors. But do you know how to translate this to financial models? This is the part of cash flow forecast that most people get confused about, the working capital schedule. Today, I will show you exactly how to calculate it and most importantly, how to project this into your model. Let's start by spotting the working capital accounts in the cash flow statement. In Amazon's case, they actually break it out for us. You can see each account listed separately. Inventories, accounts receivable, other assets, accounts payable, accrued expenses and other, and unearned revenue. That means we can tell exactly what they include in their working capital calculation. Now, don't get stuck trying to reconcile every historical movement back to the balance sheet. In the actuals, there are often adjustments that aren't purely operational. The inventory coming from an acquisition, for example, they should probably be treated as an investing cash flow and not operating cash flow, but they're still inventory. Because we usually don't have enough detail to strip all of that out, the simplest approach in projection is to base our driver on the full actual balances. It keeps things clean and directionally correct, which is what matters for forecasting. All right. Now let's grab the same accounts we just spotted on the cash flow statement, but this time from Amazon's balance sheet. I've got 2023 and 2024 here. Inventories, accounts receivable, accounts payable, and other current assets or current liabilities as they were considering in the cash flow statement. I'm going to copy those into Excel and you have them all in one place. This will be the base for our forecast. From here, we will calculate the year-over-year changes to see the historical movement, and then we'll replace those with driver-based assumptions for the projection period. Okay, I pasted the actuals from the balance sheet into the Excel sheet, and now we are going to project the next 5 years of those accounts for the balance sheet. I also had to bring in from my income statement my total sales and my total cost of sales. Of course, when you see in the income statement, there is two types of sales there. There's one sales for products and one sales for services. We are not going to separate that now because we don't know what type of separation there is in the current assets and liabilities. So we just want to use the total for simplification. Of course, if you know better, if you have more detail, then you probably are more able to do a more precise forecast. For now, we just want to understand the theory behind all of this. So I brought here from the income statement, and I am going to need to project this into the future. Of course, if you're doing a full financial model, you're probably projecting the revenue and projecting your costs already, and that's what you're going to bring here. But for now, I'm not doing anything better, so I'm just going to do a simple calculation to project this revenue and costs into the future. So I already put it here. And I'm going to leave this file later for you to see the formulas, but I just use a simple calculation with averages of growth and average of percentage of cost of sales on top of the revenue. So it's very simple, a very simple way to calculate. My goal here is to focus on the balance sheet accounts and the working capital accounts. So to be able to project those accounts in the future, I need to use an indicator, a driver, which is going to be how many days it represents from sales and from cost, depending on the account. So you're going to transform all of them in days. And to do so, I will start by calculating how many days we have in each one of those periods. So days in the period. And I'll use a simple formula, which is date. And I'll use this year. And 12 and 31, which is the last day of this year, minus date again. And now I'm going to use this year minus 1 and 12 and 31st, which is the last day of last year. And when I do that, I have 365 days in the year of 2022. So I'm going to just to pull that to the side. And now I have exactly how many days I had on each one of those years. So that's what I'm going to use to calculate the days of each one of those accounts. So I'll copy those lines right here. And I will create the drivers, days of each one of those accounts. Those are the drivers for me to calculate and project those accounts in the future. So I'm going to just put it here like this. So it shows something special. Let me just make this smaller. And now I can calculate each one in terms of days from the actuals. And that's what I'm going to use in the future to project them. So let's start with the inventories. That's what we have right here. And I'm going to start with 2023 because I don't have 2022. So I will just divide it. How much of the inventories, how much of the cost was stuck in the inventories on the last day of this period? So just divide that by costs, and then I'll multiply that by the number of days in the period. As simple as that. So we had on the end of this period, we had 39 days of inventory stuck in the inventory. We had 39 days equivalent of cost of sales stuck in the inventory. That's what this driver means. So I'm going to calculate the others based on what makes sense to each account. For in the case of inventories, it makes sense to calculate based on the cost of sales. But in the case of accounts receivable, for example, or unearned revenue, it makes more sense to calculate based on sales because that's totally related to sales. So that's why I brought both sales and cost of sales right here. And that's how I'm going to calculate all of those lines in days. So after calculating each one of the days, each one of the lines in terms of days, based on what makes more sense for each one, I have here the days of inventory, the days of accounts receivable, accounts payable, accrued expenses, and unearned revenue. So if you see the classic cash conversion cycle, we did a calculation here of using inventories, days of accounts receivable, and days of accounts payable. But we have a broader cash conversion cycle that uses all of those, and it would be a little more because if you see on the cash flow statement of Amazon, there's also other assets, other current assets that we don't know for sure what's in there because there might be pieces of other accounts and there's no way to know what is the detail behind it, so I'm not projecting those. So if you see on a broader perspective, we see that Amazon actually received money way before it had to pay. And if you see the logic behind this, unearned revenue, for example, it receives money before it even render the service, which is probably AWS. So you see here, unearned revenue brings a much better situation to the cash conversion cycle, also improving the cash conversion cycle. So the broader cash conversion cycle is even better, 115 days. So we are going to use those drivers here to project those accounts in the future. So to use that, I'm going to use an average, simple average. There are ways that you can do if you have any kind of strategy in place that you want to put it here. You can use, you don't have to base yourself on averages. You can just put the number of days that you are aiming to achieve. And that's totally fine. It can be a scenario. It can be used to projects the cash flow based on scenarios. But here I'm just going to use an average of those two, and I'm going to keep a moving average all the way through. Now that I have all of those projected, all of the days, those are going to be the drivers for my accounts in the balance sheet. So to do so, I will just calculate the other way around. So to calculate the days, I divided the accounts divided by whatever I had in the sales or cost, whatever was appropriate, and then multiply by the number of days in the period. Now I'm going to do the opposite. I'm going to check this divided by the period, and I will multiply by whatever is appropriate. In this case of inventories, the cost of sales. So now when I do this, I have exactly how I am projecting to be in the inventories, how much of my cost of sales I'm projecting to be stuck in the inventory by the end of 2025. Now I calculated the other accounts using the same logic. Of course, for some of them I use net sales, for other I use cost of sales, but it's the same logic that I used based on how many days on the end of the period. Notice that for this one, I'm not using averages of the balances because I want to know what is that I want to project for the end of the period. So I'm using the ending balance and calculating based on that. So after I do that, I even calculated the cash conversion cycle just for fun, just to see how it goes for the projected years. And then I'm going to calculate now the working capital. And remember the formula for the working capital, it's current assets minus current liabilities. So this is pretty simple. I'm just going to do this plus this, which are the assets, minus the sum of those three. And now we have a negative 75 in the working capital. It means that they're not putting money there. They're just using the money that is already being paid by the customers. So we have here the working capital, and because we are doing this assets minus liabilities, we want to see the changes in the working capital, the changes year over year. So we are going to calculate this change in working capital, and that's going to go to our cash flow statement. So we can start by this one. We are not going to attempt to calculate, to match whatever we have in the cash flow. As I said before, there are many things in the cash flow that were excluded or adjusted because they have more details of the actuals. We are not attempting to do that. We are just doing this for an exercise of projection. So I'm going to start by 2025, and I'm going to do this minus this. So that's the change in my working capital. It means that from 2024 to 2025, my working capital increased 13 million. So that's going to go straight to the cash flow statement, and this is going to go to my balance sheet. So that's the output for my financial modeling. If I am projecting the working capital, it doesn't matter if it's positive or negative. It doesn't matter if your cash conversion cycle is positive or negative. The calculation is the same. You're going to calculate each one of the balance sheet accounts, and those are going to be the outputs that goes straight to your balance sheet on the projection side. And you're going to calculate the change in the working capital that's going to adjust your operating cash flow in the cash flow statement. And that's how you balance the balance sheet. Now you know how to calculate the cash flow. I bet you'll never be confused again about the working capital in a model. If you want to understand why negative working capital can actually be a huge advantage and what it means to have a negative cash conversion cycle, go watch my previous video. I'll link it right here. And I'll leave it a link in the file for the calculation that we did right now and Amazon's 10K so you can take a look by yourself. I'll leave everything in the description below. Don't forget to like and subscribe if you don't want to miss the next lesson. I'll see you in the next one.